Hey guys, I'm back with some more stock research. I found one, in my opinion, that has 200+% upsides and has been causing a significant disruption in the payment and processing software space. The name is Shift4. So let's hop into it. What is Shift4? They're a leading provider of software and payment processing solutions. They're based out of the United States, and they're a leader based on the total volume of payments processed annually. Shift4 operates in multiple industries: hospitality, gambling, casinos, hotels, e-commerce, and they're still growing and adding new features. And for all you annual recurring revenue lovers like me, the company generates over 100 million from subscription revenue, and they're expected to add more venues. They're quite heavy on their revenue concentration, with 90% of their revenue coming from processing payment fees. Restaurants really typically stink when you have to deal with multiple companies. Anyone who's ever run or worked in a restaurant probably already knows this. So Shift4, you know, tying it up for us in a pretty bow, offers everything together from inventory management to table management to payments and kitchen orders. Here's a cool infographic that shows Shift4's dominance across not only restaurants, but hotels and sports and entertainment, as well as pursuing a international presence. Shift4 is another founder-led company. If you guys watch my past videos, you know I love these companies. I personally love to invest in them. There's Harvard Business Review studies that show they tend to outperform by a large margin non-founder-led companies, which is pretty interesting. Going on here, I have a screenshot below of insiders selling and buying. You can see, nominal sells 71,000, 300,000, 80,000. People can sell for a lot of reasons, but you really only buy for one reason. And the founder and CEO, Jared Isaacman, has bought his largest purchase ever at over $16 million worth of the shares on August 10th. So you guys can take a second and pause the video and read these comments from management, their most recent quarterly filing report about guidance. But to summarize it in all, they had an excellent quarter and are revising their guidance upwards. Here's Shift4's current income statement as well as their cash flow statement. As you can see, over the past 5 years, they've had double-digit growth. 78% in 2021, 46% in 2022, 29% in 2023, 30% in 2024, and they're on for track for about 10% growth again in the last 12 months here. Their gross profit also has expanded from 20.4% in 2021 all the way up to 30.5% in LTM 2025, which is almost a 50% expansion on their margins. Free cash flow has also expanded for the last 5 years, given it was negative 15.3 million but now it's crawled all the way up to 397.6 million, or an 11% free cash flow margin as of the LTM period. So here's a compressed DCF for Shift4 Payments. Conservatively estimating they can reach 10.6 billion in revenue by 2034, our terminal period here in my model. It's conservative because it really doesn't even take into guidance the consideration and guidance for management of their 30% growth over the next 4 years. You can see in the model I have here, it grows 30% in 25, 25% in 2026, 20% in 2027, 28% in 2028, 10% in 2029, and teeters downward from 8.5 all the way to 3% in the terminal period. It's interesting because as of now, Shift has about 3.3 billion in revenue, and competitors in this space are generating anywhere from 5 billion to 24 billion in revenue. And in my opinion, Four is poised to take market share through their all-in-one platform. Having everything tied up real neatly in a bow can help run things much more smoothly from a restaurant perspective, from a vending entertainment perspective, and so on. In the DCF here, I'm assuming a 13 to 14% cash flow margin, free cash flow margin through 2028, and then it incrementally hops up in 29 and 2033 to 17%. I again think that's conservative. You can see other players in this space making 22 to 24%. I think in the terminal they'll eventually get there, but just to be conservative here, over the next couple of years, and then just in the conservative overall analysis, I've kind of put that downward. Using a 10% discount rate, in my opinion, normal. I mean, a lot of the inputs, and that's why I'm not doing a full DCF. And in my opinion, a lot of the inputs are so volatile using one different discount rate or a subjective difference. So, I mean, in the bigger picture, you can have a big fancy model, a little model. I have both. I do it professionally for a job. In my opinion, this gets you into the same ballpark. If you can really project what that terminal period looks like, and their profit margin, I mean, that's at the end of the day, the worth of anything is the present value of the future cash flows. If you can somewhat get down that timing of when those cash flows are coming, you'll get a pretty accurate answer. So flow net through, I get an enterprise value of 19.1 billion or an implied price of $278 plus 200% upside on this stock. I really like this. Here are four solid competitors I pulled data for various valuation metrics on an LTM basis, as well as for a forward basis. We have enterprise value to earnings before interest, tax, depreciation, and amortization, market cap to levered free cash flow, price to sales, forward price to earnings, forward market cap to free cash flow, forward free cash flow yield, revenue growth over the past 5 years, their free cash flow margin, their last 12 months revenue, and their enterprise value. Running all this, and basically I like to compare our company. I have bolded to the median. I have bolded, right? There are some outliers here. You can see Toast, for large part, seems to be an outlier in terms of multiples, but going down, I like to compare it to the median. And as you can see, I kind of just rudimentarily have a four analysis, right? Four being the stock. The analysis being, EV to EBITDA, what's its price to the average competitors in the market. So we're at 13.69 times versus 19, which would signal, we're undervalued, from that perspective. Keep going, but applying that logic, straight down the line there, you can see that they're returning a score of, in my model, 88% undervalued here. It's interesting too because you can see their free cash flow yield is 10.1%, which is the second strongest of the group, and they have the smallest enterprise value or size of their company, what you'd have to pay to acquire it all, as well as smallest revenue. And with their all-in-one platform, I really think they're poised to take more market share from competitors here. Um, Assuming a forward free cash flow average multiple of 18.73 from our market comparison, an estimated for forward free cash flow for four of 528 million, and add debt, subtract cash, you get an enterprise value of 10.4 billion. This implies a price of $152 or an upside of almost 70%. I mean, I really like this stock, and I'll just end it here and hope you guys enjoyed and do your own research.